Thank you so much for joining us this morning. No chit-chatting, Tom. We have work to do. I'm not even going to introduce our panel because clearly you know who everyone here is. Leading minds in terms of real estate. So many people, whether they live in New York, London, LA, or Chicago, are simply saying, are these prices sustainable? And then you blink your eye and an apartment in New York goes for $100 million and you say, clearly they are. So I just want to go down the line and really get everyone's take. Real estate values around the world. Sam, what do you think, besides the fact that everything you own is just super valuable and should be worth more?
Well, I think that the world is, the real estate world, internationally is in reasonably good shape. I think that there's a serious question going forward about how the world is going to handle the dramatic change in our currencies and the very strong dollar against dramatic devaluations somewhat competitively in other markets. And so I think that's going to have a major impact. But if you think about real estate worldwide, and by the way, you wouldn't make much of a distinction between real estate and everything else, the world is short of demand. And it's true everywhere. And the question becomes, how do you invest in real estate that's dependent on demand, and how do you determine where demand is going to be in the future? Clearly, a major focus of that is going to be demographics. And this is probably the worst demographic scenario the world has had.
The worst?
Yeah, in maybe 500 years. Well, you got 8 countries in Europe, they have less people in them on December 31st than they had in January 1st. You've got, the birth rate is going down around the world. So where's the demand going to come from? And Japan, and they're predicting Japan's going to have 50 million people, by 2050, from 130 million today. That might be a problem for real estate.
There you go. John, what do you think?
Yeah, same thing. We've seen a global allocation of real estate's gone up. It's a search for returns. And then everybody's gone for the grade A assets. Asia's not been immune from that. We've seen an acceleration of prices in the most transparent, easy cities like Hong Kong, Singapore, Tokyo, compressing to very similar rates to where you're seeing in the States. So it's hard to get office less than or greater than 3% cap rates. And that's because alternative assets, whether it's money in the bank or JGB bonds in the case of Japan, are returning such low returns. They're seeing the positive carry on assets. They're borrowing at probably something at around about 2%. So real estate's become a very attractive asset class in the key cities, but it's probably reached its max point in the more mature economies. Remember, there aren't many alternatives for people right now, and we've exported Japan's problem to the world, which is basically where do you put your cash for outperformance returns, particularly for pension funds. How are they going to get their returns? And I think that's seen a sweeping move into more colorful markets as people hunt down higher yields.
What do you think?
I think that the real estate market is not a cohesive market as such. In city centers, in economies which are prospering, like in the US and the UK, real estate is ending up being a major store of alternative return. In China, it was for a while.
Meaning people are just parking cash in US real estate.
Correct. In China, it was more so the case in residential real estate, where the average Chinese who was turning his salary into a purchase of an additional apartment, hoping that the value would continue to escalate. Much to his surprise, there were some hiccups on the way. But in New York, London, Holland, in major economies, you see the demand for high-end and for income-producing assets being on the rise, the result of which yields are coming down and prices are coming up. I don't have a problem with real estate values coming down in the near future.
What do you mean when you say you don't have a problem with it?
I don't think that real estate values are going to come down anytime soon.
And that's just because the supremely wealthy are only getting richer?
One of the reasons, and corporations are making vast amounts of money, and they need areas to invest. And real estate is not an asset class which replenishes itself in a very short time. So any existing stock is being bid heavily by institutions and by individuals, and they're all causing yields to come down significantly. So you start seeing properties in London, large-scale assets trading at 2.5% to 3.5%. New York has also had a yield compression, and it has similar effect on residential. The top-end residential, which is scarcer commodity, is seeing prices which are unheard of before.
Linda?
I would observe that I think there are a couple of distinctions in the real estate market today. Certainly transaction volume is predicted to exceed 2014 transaction volume at a fair pace, but the sources of capital that we're seeing in the market right now are different than we've seen before. So we have public players investing. The hedge funds have moved into the real estate market. Real estate private equity is dominant, and you've got money coming into the U.S., certainly from outside the U.S., and money from the U.S. going overseas as well. So I think that mix is certainly supporting the market at this point in time, and could have some very interesting long-term implications, though, because different types of investors obviously have different hold horizons, different goals, different return expectations, and if at some point when we do again, hit a downturn of some nature, the different capital sources could put different pressures on us in different places in the market.
Tom, to you, does that mean welcome back to the housing crisis when investors who shouldn't have been in certain asset classes were, and when the market turned and everyone looked for the exit, they couldn't get out the door?
Yeah, I think the problem isn't real estate. The problem is debt, right? I mean, if you look, real estate. One of the lessons that we've learned from the financial crisis is that real estate is actually very forgiving. Floating rate debt is not. So the correction in all these markets, it's hard enough to talk about the 310 or 212 area code when you talk about real estate, right? This global idea is impossible, and that's the benefit of real estate, is there is no homogeneity of anything. There's no homogeneity of product, there's no homogeneity of leases, there's no homogeneity of legal structure, and every time you think you're really smart, you just look out the door and see how many buildings you didn't build, or that even Sam doesn't own, right? There's a lot out there, and there's people micromanaging at the edges. But a simple way to look at it, and I think Sam is right on demand. The other part that plays into demand is technology, right? Everything is being disintermediated. So why do you need more of anything? Do you need more of office buildings? Do you need more hospitality when you have Airbnb? Do you need more industrial logistics center? I mean, my house looks like an Amazon.com logistics center in the garage, right? People are shopping differently. But if you're taking a long-only view of real estate, reasonably leveraged, matched assets to liabilities over a long term, you're fine. The problem is when you start adding a volatile short-term floating rate debt underneath it, you start running into problems.
Do you think the Airbnbs of the world are that disruptive? Do you think they're really impacting the hospitality industry in a big, big way?
But they're killing it, of course.
Yeah.
If you look at a hospitality provider, if you're a manager and you have to adapt to all of the regulatory environment, all the tax environment, all of the local handicap requirements, fire, life, safety, the technology of keeping up with full-time employees, you just impute that on a capital structure that has to comply with all that versus a non-asset intensive engine management function, they can't compete. It's Uber, right? Airbnb is Uber. So eventually, the hotel management business invented this idea of 30-year only, long only, no-cut contracts. And when Eyal wants to own a hotel and have it managed by somebody else, he finds out very quickly. They call and say, you know, we can do a great job for you. If you just add Frette sheets, we need some more silver, buy 5 Rolls Royces, people need 5 more swimming pools, and we can raise the rate by $10, but of course we're not going to put any money into your hotel. We want 10% of the net and 3% of the gross, and you put up all the money. Who invented this? Right? It's insane. Versus Airbnb, which nobody thought was going to happen, for excess utilization of every product imaginable, which is just a search engine. So until the owner of that apartment or house or resort facility has to comply with the same mandates that an operator has to maintain with,
Which will be right after never.
never happens. So I think you're going to see a consolidation. Eventually you're going to have a hotel manager merge with Airbnb, and then it'll be game over, my opinion.
You agree?
I think it's a transformative process. There's no question. No different than when the hotel industry used to be run by high-end hotels, and then the Holiday Inn and the Howard Johnson and the smaller hotel operators came in and said, I can offer you a different product. And they found their niche, and they did stable alongside the bigger operators. Airbnb, no question, is a destructive force, but it will change the industry. Everybody else will adopt accordingly. No different than Uber, changing the transportation industry in the world.
Is it affecting your businesses, though, and the way you're planning your businesses when you think about this kind of disruption?
You're just asking me?
Sure.
No.
Sam, let's talk international. You know, people are talking searching for yield. When you're looking at regions like Latin America, Southeast Asia, where does it make most sense for you and why? Regions outside the United States, Latin America, Southeast Asia, developing countries, where are you most excited?
I think right now we're very excited about Mexico. I think that Mexico represents maybe one of the best risk-reward ratios in the world.
¿Por qué?
¿Por qué? Well, start with Fukushima. The Fukushima earthquake.
Doesn't make me think of Mexico.
Huh?
Doesn't make me think of Mexico, actually.
Well, the Fukushima earthquake seriously disturbed the worldwide supply chain. And companies, I mean, nobody really realized how much stuff is made in Japan, exported to China, incorporated in a product, and then exported to the rest of the world. When Fukushima happened, the supply chain was challenged. And every single major player in the world said, it can't be dependent on only one supply chain.
Every single manufacturer?
Yeah. And the answer to that question was Mexico. And the result is, over the last 5 or 6 years, in central Mexico, you no longer have maquiladoras, which were assembly plants. You have VW manufacturing cars. You have Bombardier manufacturing planes. I mean, you're building a giant industrial complex that is going to have enormous implications on Mexico, combined with the reforms at Pemex. So Mexico would be probably our #1 target in the world. I think our second target would probably be India. We spent 10 years looking in India. And while a lot of our competitors played and got buried, we just kept watching. And the election of Modi, I think, is an enormous plus. And I think that things are moving better. Now, the definition of moving better by Indian standards is a lot different than anything you and I know about. But the prospects in India today are the best that they have been in the last 10 or 12 years. A third country that's of interest to us is Colombia. And Colombia, interesting enough with what's going on with the trade pact, it is enormously benefiting from the free trade agreement with the United States. And the result is that all kinds of companies are moving into Colombia and using that as their base for doing business with the United States. which is creating very positive demand. So if you had to ask me, which 3 places I'd want to invest in, or I am investing in, I would say those 3. And obviously, when you define the term, you have to define a lot more than just the demographics. It's obviously demand, it's issues that are going on around that country that all add to its attractiveness.
Are you starting to look at Cuba?
You'd think that Cuba is going to be terrific. The problem is I'm 73. And I mean, there's a lot of euphoria about Colombia right now, about Cuba right now.
Sam, Castro is 91.
Huh?
Castro is 91. And
yes, I know.
He ain't going anywhere.
And he's still there. And his brother is still there. So anybody who thinks there's going to be some dramatic Americanization of Cuba is just kidding themselves. Over time, I think particularly as a tourist attraction, Cuba is going to do very well. I think that the process of converting Cuba to a 21st century country with investment opportunities, as I said, I think that's for the next generation.
John, what do you think?
I'm going to
saw you nodding your head at Cuba. You didn't necessarily
I'm going to take a high-risk strategy here and agree with a legend, which is Sanzel. India. The problems we find in India are nothing to do with perhaps Modi's election, big tick. It's positive. There are going to be changes, albeit slowly, in a coalition government. We have a bigger view on this. The biggest issues with India are probably the currency. The ability to get your capital in and out is very, very difficult. Product availability, because there is very limited existing product, you're going to have to create product. To be a creator of product, you do have to have a 10-year long-term strategy. You have to go into a joint venture, and you have to be a developer, all of which add layers of risk we think are probably unnecessary at this point in the cycle. So we would rather see, for example, Modi, how he plays out. Does he really make structural changes? Because even last week, they introduced another tax, which is punitive on foreign investors going into the country. So I think there are barriers to entry and exit in India, which make it very, very difficult for the average investor to put a meaningful amount of capital to work there. So we've looked at more the markets which we perceive are more receptive to foreign investment. So global cities, I still think that there's a lot of cash to be made in Japan. It's still possible that you can get 20+ returns and good multiples in Tokyo, Osaka. At this stage, they're only in the first and second year of this refinancing exercise that they're taking, this liquidity rush. There are issues in Japan. You mentioned something about aging population. But look at female worker participation in Japan. It's only close to 20%. In Holland, it's something like 60%. So they have some remedies they can put in place if they're willing to. Immigration is the lowest in the world into Japan. Again, he's looking at changing some of those issues. So I see the macro and the micro story. I would still pick Japan as currently the strongest of the markets. China, it's got a lot of publicity, what's going on in China. Our view, this restructuring is well underway in China. It's self-imposed, a lot of what they're doing there. The slowdown is self-engineered, but the government is in control. They have problems on debt. There are speed bumps. Those are opportunities. If you're counter-cyclical and take a long-term view, do you believe Shanghai and Beijing are going to be relevant to the Asian economies going out 10 years? These low points when there's a lack of liquidity are exactly the times you should be looking at those markets.
But I'd ask you a question, and that is, does China need your capital?
Today, yes. It didn't 4 to 5 years ago because in post-2008, they injected liquidity into the market, the banks were full of cash, and lending was very, very easy. So that for a long period of time, they didn't need your cash. Today, the banks have had the squeeze put on them not to lend to real estate. We've seen developers and the first signs of some small and medium cap developers going under because that's by choice. The Chinese government was almost picking and choosing, saying every few months we might let these companies go down. That lack of liquidity right now, if you have a macro view, that's our entry point. They didn't need us before, they do today. So I think the opportunities at the corporate level, which I'll give them a plug, Blackstone are targeting, are very good. I'm going into a more targeted strategy where we're individually looking at groups we can target portfolios or individual assets from distressed sellers. I've not seen that happen for the last 10 years, where they're receptive and you can get financing locally, which as a foreigner has been tough in the past, but it's certainly possible.
How easy has it been for you to get a discount?
On pricing?
I went to Hong Kong in 1984, and Hong Kong was a total mess. And I said, wow, this is the grave dancer's opportunity. And buildings were half empty. I went around and saw every bank in Hong Kong. You know how much of a discount I was offered to buy any of that shit? Zero.
Zero.
I mean, the difference between the American system of take your hits and move on and the Asian and European approach of pretend and extend, I think is a challenge to an investor.
Isn't that a cultural thing, Sam?
I'm sorry?
But isn't that a cultural thing? I mean, if you look at Europe, Greece is in a financial crisis, but all those Greeks are going to be on vacation all summer.
No, they were in vacation all winter.
There you go.
They extended it to the summer.
But it may be cultural, but the answer to your cultural question is that therefore that culture is less likely to recover as quickly as in the US, where you take your hit, move it on, and reinvest the capital and grow accordingly.
But fast forward to 97, so you've had your 84, 97 with the Asian financial crisis, and I agree, but the distress was never in the biggest corporations. There were no grade A assets for sale, but there were reams of grade B assets. If you go down a tier, there's plenty of deals in the next tier down. We didn't see Hong Kong Land or Chung Kong or these groups. They've got such low leverage, they were able to hold through those difficult periods, going to what Tom was saying earlier. And I think what we saw was if you're willing to go down a layer, but still good locations, but grade B buildings, they're available now. They're still available in Hong Kong, Singapore, Tokyo today, which is still cleaning up from the downturn in 2008. There's still $1 trillion worth of bad loans in Tokyo.
And I guess my attitude
it's about being selective.
Yeah, I guess my attitude is that if I'm going to leave the United States, it's not going to be to buy B assets in Asia.
Again, it depends if you've got a global strategy, which you have.
Yeah.
Why would you take the risk in Mexico versus Tokyo?
I think it's a question of what's the opportunity. I mean, the answer is we're building stuff in Tokyo today, but we're building very, very specialized facilities that don't exist. And so we're doing very well. But generally speaking, all of the demand in Japan is in Osaka and Tokyo.
Great.
And I'm worried about, the ultimate impact on the country of this deteriorating demographic condition.
But these are mega cities, and there's net migration, positive migration to Tokyo and Osaka. So you have got aging populations, but these are two cities. Osaka's GDP is bigger than Denmark's.
Yeah, how old are the people migrating?
They're pretty young. They're younger than you.
Isn't everybody?
Eyal, when we look at the risks associated with internationally investing, do you look at New York and simply say, the market in New York is bulletproof?
I want to tell you, everything is relative. I'll share with you my experience around the world. We spoke about Southeast Asia and China. I have got personal experiences in countries which were emerging, which offered phenomenal opportunities like Turkey, Bulgaria, Romania, Georgia, Latvia, Poland. And the experience was awful.
Was awful?
Yeah.
Was it a rule of law issue?
It's a rule of law. It's lack of, it started with the rule of law. And then failure of the economies. And change of leaderships. Change of governments. As a result of which the at the end of this round, we came to the conclusion there's only one good place to invest money in America. Is America bulletproof? No. Comparatively speaking, yes.
I think there are lots of foreign investors who agree with you. If you look at the flood of money coming into the US, particularly out of China, you look at the flood of money coming in from countries like Norway and other Europeans, one has to wonder about what kinds of returns they're looking for. And what we see is that they're looking for lower returns. Particularly the Chinese want a safe haven for their money. They want to be able to get it back. They're not so worried about how much they make on it. And there is a concern in the market, I think, that I see and live every day in bidding wars for assets, that all of this investment and this money that's willing to bid up the price for a lower return is propping up, you know, the U.S. real estate market to a certain degree. I'd be interested in your
Falsely propping it up?
Mm-hmm.
Well, isn't it at the end of the day, if we're all worried about two primary things. Number one, capital preservation for our investors, right? How do we not lose money is rule number one. I think that's what we learned from the great financial crisis. And number two, what is the risk premium for all of these places? So John and Sam have an edge wherever their point of view is on a venue. And then they can create an executable idea or transaction or an engine that pervades beyond the cyclical implications of what might be, right? At the end of the day, you need to find a transactable idea. The great thing about real estate is you can have transactable ideas from an apartment to the Sears Tower. And the disintermediation across the financial industries in most countries, starting here with Dodd-Frank, the Volcker rule, all the things we're dealing with now on risk retention, capital realignment, GE getting out of the finance business, all those things create huge opportunities across a credit spectrum that has much better risk profile than other things, but the return may be much less. Everybody's in a search for yield, right? So total return and what the risk premium is on total return is fading because institutions have actuarial hurdles and they're trying to meet those actuarial hurdles. And everybody looks at real estate as a tip. It has yield, it has the hope of an inflationary hedge, which may or may not be. And then you switch to Europe. So Europe was an investable theme 18 months ago. We looked at distress and said distress is jumping across the pond. And we as Yankees said, well, there must be a predictable legal system, which there is not. Yeah. There must be a resolution strategy, which there is not. We must have a central banking system within Europe that will protect foreign investors against defunct borrowers. There is not.
Okay, well, we're not going to get any of those.
No, and the currency, by the way, adjusted 25%. So if you bought down 25 on a leverage basis, you just lost whatever your premium was on the gain in your currency. So I think the beauty of real estate at this point in the cycle, it's all about supply and demand. And I think fortunately for all of us, we're not out of sync in most places of supply and demand of product. We're out of sync of supply and demand of money. So the people who create great engines to continue to make those investable themes, Sam has done that through every cycle. So you have a real business. It's not a trade. Nobody's good enough every morning to wake up and say, I'm going to have positive only trades every day on a conservatively leveraged basis with income in place and total return.
I think, Tom, another way of saying what you're saying is that we began this panel talking about, quote, global real estate. But the reality is real estate is all about a series of individual transactions. In the hottest market, there's deals to be done. In the coldest market, there are deals to be done. And part of the charm and attraction of real estate is that there is no, quote, global solution one way or the other. And I've done some of the greatest deals in my life in what you'd think would be a horrendous market. And I've done other terrific deals or done what I thought were great deals that turned out to be lousy deals in what should have been a great market. So in the end, it all comes down to the brick and mortar decisions that you make, and that you can't get too lost in generalizations, because I don't think that's the way you make money in real estate.
Then
Make
is it
on the specifics.
Excuse me. Then is it about being a long-term player? Because right now, since there are non-professional real estate investors making your space crowded, bidding up assets, making your job more difficult as things get more expensive, well, in a few years, they're likely to get chewed up and spit out. So even though things are competitive today, you may get great opportunities out of this in 2 or 3 years.
History says you're right. Each cycle has its own unique characteristics, and I would be reticent to be a predictor of what the next, what the next issue or opportunity will be. But I also would be very reticent to make assumptions. I mean, it's pretty hard to make an assumption that a sovereign wealth fund is going to spit it out after 3 years. It's much more likely they're going to keep it for 30 years when they should have sold it after 10. But so you got, part of what's going on here is, I mean, if you listen to your question, you'd almost think that there were a bunch of little old ladies from Pasadena who were getting their pushkis together and buying office buildings in New York. Okay? I don't think that's, exactly what's happening. The additional capital into the real estate industry in the last 10 years or last really 20 years is all about allocation. It's all about, I mean, think about the fact that in 1990, when I was raising money for a real estate opportunity fund, I was calling on pension funds and major institutions that had no allocation to real estate. None. Not 1%, none. And you'd sit there and they'd say, wow, it's a risky this and it's a that. But they had no, and today, there's no such thing as an institution without a significant, not a 1%, but a significant allocation to real estate. So it's not like we have a whole bunch of amateurs who are now competing with us. We just have a whole bunch of people who maybe don't have as much experience as we do, but they have a hell of a lot more capital than we have. And so that's why you're seeing lower cap rates and this kind of competition. So I think you'd be kidding yourself to assume that 3 or 4 years from now, all of these institutions are going to go back to zero capital allocation to real estate.
Well, you're probably right, except that one of the drives for this particular phenomena is the low interest rates. If interest rates in 3, 4, 5 years are going to be hovering at a much higher rate, all those funds will be reconsidering their long-term low-yielding investments, and then
Eyal, what's the implication of those low interest rates as opposed to charging for, quote, holding your money? I mean, if you go to Switzerland today and you have $100 million, the question is, how much do you have to pay for them to hold on to your money?
Right.
We've never had that, or I've never seen that in my lifetime before. But I wonder whether you've got to connect that to the low interest rates. Because effectively, they're charging you to carry their money because they can't put it out.
True. But when they will start paying you interest for your money, you will bring all the money back. And how will you bring it? It was already invested in the U.S. real estate, yielding 2.5%.
So let me ask you David Einhorn's question. Is there a better short in the world than the German Bund?
Than the German what?
Bund, the German bonds? I mean, how can, in other words, think about that. I'm going to short a bond that somebody else is paying to carry?
It's a phenomena for a different panel. I don't know how to answer that.
Minty, you want to weigh in?
We'll have another panel in another hour.
I think there's some demographic trends that are going to influence the long-term sort of evolution of the real estate industry over the next several years. Everybody's talking about the millennials and how their drive to urbanization has changed the shape of many of our cities, New York, Boston, certainly. Then there is the effect of the graying baby boomers who are, driving demand for assisted living, independent living kinds of facilities, which are totally different kinds of asset classes. They're as much operating companies, in a sense, as they are assets, real property assets. And I think that trend's certainly seen here in the US. It's predicted that by 2050, 21.4% of the US population will be above 65. In Japan, which I don't think there's been much focus on yet, but it goes to the discussion that you guys were having earlier, by 2050 it's predicted that 36.4% of the population will be above 65. Pretty staggering number. So I think there are certain demographic drivers that are going to impact where real estate succeeds and fails over the next 30 years.
You mentioned millennials. How much of an impact is the massive student debt issue that they face going to impact real estate?
Well, there's
and
certainly
entering the market.
There's certainly a lot of talk about it now, and I think that people feel that the drive to urbanization on the part of the millennials is a result of a number of different things, and you probably have a view, but the desire to control their costs, share space, save transit expenses. There's the live, work, play lifestyle aspect that people feel is important to them as well. Look, they're coming out with a lot of debt, and if they've got to conserve costs, job growth is slow. Many of them are still at home or striving to make their first step out. It's going to impact, I think, that market.
I know the millennials are a hot topic and their lifestyle and their choices, but does it really affect your business, Tom?
Oh, sure. I mean, it's supply and demand, right? So again, when you say business, I think investors like us have to find really smart people who run those businesses, but the people who run those businesses are dealing with that every day. So, our era used to think emails were great, and then it went to Instagram, and then it goes to Snapchat, and then it goes to Tinder. But if you're not, right, if you're not in sync with how you market, we have a single-family rental business, which is done phenomenal, which is also very humbling. Seeing when Sam and I have talked about this, and Sam told me the great thing about the multifamily business, which he's been in, and the single-family rental business, which we've been in, is the ability to raise rents exists only in our minds. And I said,
one more time?
That on a pro forma, it's very easy to sit down at the beginning of a transaction and say, great, we're going to raise rents 3% each year, and expenses are going to stay stable. The only problem is after 30 years of doing this, it doesn't exactly work that way, right? But now, with technology and the way people are living, right? So kids live differently today. We're in a building in which Riot Games. These kids, the average IQ is 200. They come to school on skateboards and bikes. When I'm coming to work in the morning at 5:30, they're leaving. They live 4 in an apartment. Money is not an interest to them. They're all zillionaires that dropped out of Stanford or USC or University of Chicago in the second year, right? It's a different deal. But that's supply and demand. That's where growth is going. And if you're not in front of that, you're gonna completely miss the cycle. But I think investable themes are really simple right now. I see 3. In the U.S., the regulatory intervention that we're all suffering about, and that what has been a major theme of the conference, is a gigantic opportunity.
For Blackstone.
Well, maybe and maybe not. I mean, Blackstone did a great thing, and I've told you before, I'm one of the foundational cheerleaders of Blackstone and Steve Schwarzman and John Gray. They're brilliant, and they were the only one that could execute that size of a trade within that time frame. But it was genius for GE. Why? Because they're a SIFI. So when you hit 50 billion, the regulatory morass that it hits is an impossibility, and the market was penalizing them. So by getting rid of, in a treaty transaction to Blackstone, that amount of their finance business, which built GE, their stock bumped 9 points. They have a $90 billion distribution to their shareholders, and everybody is applauding. So how do you recycle all of that into the capital markets? And who are the entities now across all of these lines who are going to make conservative commercial real estate loans on a basis that's handleable? Securitization. So the risk retention rules have changed, again, which are now requiring the B piece of CMBS to be held for 5 years, and everybody in that stack holding 5% without getting technical. Securitization is the magic elixir for all of us, right? To match long-term debt at those kind of rates is the quest. But the B piece is what drives it. Now, all the big institutions can no longer hold that B piece. That creates an unbelievable opportunity at a very attractive place in the capital stack. So in a place like America, and I think Eyal is right, and I think all of us here owe most of whatever modicum of success we have to the American system. But that American system today, just like in Europe, the European system, the change of the regulations following behind us, is a huge opportunity right now. There is no real estate debt in that marketplace. So all the NPLs that are being purchased have to be refinanced someplace. So being able to put money out, just looking for an executable idea, on a fixed income basis at a place in the capital stack that protects itself from interest rates rising or lowering. Right? We could talk about what's going to happen to interest rates forever. None of us know. So you don't want to be in a business in which you're betting every day interest rates are going to go up or they're not. So a great office building today trades at a 2 cap. That's 50 times cash flow. 50 times cash flow. So people say, great, I'm going to put conservative leverage on it at 60%. And then I'm going to create a floating rate piece of paper, like commercial paper, underneath me, so I can get some leverage to get single-digit returns. So 1 full point of turn wiped out the 50% equity at 50 times cash flow. Is that a good bet? And we have to ask Sam. I think that it's probably right for most office buildings at a place like Chicago, if you took net effective rents today, in other words, take rents in a commercial office building, take out TIs, leasing commissions, property taxes, and current dollars, they're probably much the same today as they were in 1997. Is that about right?
Probably right.
So what are we investing in? Right? Where's the alpha? What's the spread? Is real estate for trading or is real estate for holding? That's the quest.
Different answers for different investors.
Right?
Is real estate for trading or holding?
I'm sorry?
Real estate, is it for trading or holding? How do you look at it right now?
I wrote an article in the 80s called Modern Sardine Management, which basically talked about the commoditization of real estate. And that occurred during that period of time. And when it was commoditized, it was very much of a trading vehicle. I mean, we're the largest apartment company in the country, the EQR. We own no apartments in Dallas, no apartments in Houston, no apartments in Atlanta.
Why?
Because as a public company, you do not get credit for one-time gains. So in volatile markets like those, and markets where access is very easy, the market gets hot and then it gets cold. For 25 years, I bought in Dallas at the bottom and sold in Dallas at the top. But as a public company, I don't get credit for that. And what the public wants are continuous, transparent, predictable earnings. And that's not trading. That's investing and managing and operating. And when you look at the public markets, you're going to find that the public markets are not trading markets. The public markets are higher quality, long-term ownership assets. The private market is very much of a trading market. And that's fine, but it's a very, very different animal than long-term investing.
John?
Yeah, it's very well enunciated. We've got the same issue in Asia. I'd say it's a trading mentality. Most of the public companies that get priced the best are development companies, so they're trading. We run private equity, and we're very much in a trading mode. We have a number of factors that are pressure. We're much more volatile in Asia. We have shorter cycles. We have lease lengths, which will cause you nerve-wracked pain in the West, which is anything from 1 to 3 year turnovers of lease, which creates a level of volatility because the cycles are so short. And if you're caught on the wrong end of that, So you have to stay pretty light on your feet, but within all of that, that volatility gives you a lot of opportunities. So timing is probably everything, as Sam has mentioned, as much as the location. Location will save you if your timing's wrong. Then you become a short-term holder of an asset, you can become a long-term holder, and the location will bring you back in the next cycle if you've got the right asset management skills. But for us, I would say it's a tactical play in most of Asia. You're going in between all of these markets. It's a highly illiquid asset, obviously, real estate, but you try and stay in a sector where you already know that there's massive exit liquidity. So your deal size, how you predict which city you go to has the most exit liquidity, and that's why we tend to pick global cities where we know there's a very strong public and private market and a deep pool of sellers. I think you've got to have that mentality, especially in Asia at the moment, although it's changing. So we are maturing as we go along. The biggest growth in the REIT market in the last 20 years has been in Japan, and I'll include Australia. We're 25, 30 years behind the USA, you have to remember that, but it is catching up. Some of the concepts you've got there are getting through in Asia as we increase transparency. It was an interesting comment made by, I think it was Minter earlier, just to address that issue about the Chinese. Remember, they're starting from a zero base of foreign investment. So now you're seeing a flood of capital. It's pretty easy to say it's a lot of capital when it's been zero for so long. And I think what you've found out recently is these pension funds didn't exist 10 years ago and had no ability or capacity from the government to be allowed to go offshore. The government have passed an edict saying, please go offshore to diversify, not a flee from your markets and a lack of confidence in your own markets, just diversify. So you're going to see what the States and where the States was, where Sam was talking to people in the 1990s saying we have no real estate allocation, and then they had zero for foreign real estate. Now the Chinese, and the Japanese, the Koreans, and the Malaysians, they've actually got very large pension funds and insurance companies, and they want to diversify. So this capital you're seeing is coming, and it will be permanent. It will stay in the marketplaces and probably will increase over the next 5 years.
But as much of a trading mentality as Asia represents, Li Ka-shing didn't sell any of his buildings.
No, exactly.
I mean, and neither did the Kwaks, or neither did anybody else.
They have a core asset holding in in their home base, Hong Kong, and particularly as the Japanese do in Mitsubishi, all these groups. So the big groups will never sell those core assets, but they also have huge portfolios of other assets. They're not all they're B pluses, or they're assets which they are run down, and you can come in with a value add proposition and they'll still sell to you as a non-core asset. But you won't buy their crown jewels.
Yeah.
You won't buy their crown jewels.
Eyal, recently Larry Fink has said high-end apartments are a better store, in big cities, are a better store of wealth than gold these days. So on the surface, that would be a huge positive for you. Great, wealthy people, come on over, park your money here, buy these high-end apartments. But is it a risk? Because as soon as there's even a blip in the markets, it's those type of investments that they'll try to flip out of.
No question it's a risk. The question is when this will occur. Currently, and as I see going forward, high-end apartments are very good alternative to storing gold. Gold fluctuates far too much. High-end apartments are not.
But it's far more liquid.
When there are buyers. When there are no buyers, they are much less liquid. Are you talking about gold?
Gold. I'm saying gold is far more liquid.
Yes.
So
yes, but it's much less useful. So storing, the people who buy a high-end apartment don't buy just as a pure investment of parking the apartment somewhere. They're going to furnish it, they're going to decorate it, and they're going to have a family member living there sooner or later. So if it's a foreign buyer, be it East European, he has in mind of putting in one of his kids in the future. If it's a Chinese one, very similar scenario.
And Eyal, don't you think part of the attraction, especially at the high end that you deal in, is if you are a wealthy foreigner today, and The benefit of central bank intervention all over the world has been given to the pockets of 5% of the population, amazingly enough. But with the Bank Secrecy Anti-Money Laundering Act around the world, you cannot move $5 million from Bank A to Bank B. The Know Your Customer law has caused havoc in the institutional international financial business. So one of the last bastions of safe deposit boxes left is high-end real estate.
Mm-hmm.
So in a place like New York City, what you're seeing is a mirror of all the things that the panel's been saying, of transparency, a legal system, a safe playing field, a currency that's understandable and predictable, and a proliferation of money that has nowhere else to go. And not flight capital, not gray capital, or real capital. So it's an amazing phenomenon.
And which proved to be the case in New York and in London. When there are so few, relatively, high-end products, there are many more buyers than everybody predicted.
Then is the real estate market, or at least in the US or New York and London, a direct reflection of the income inequality issue, where wealthy people have become so wealthy, there is no price point that's too high, and you've got new home buying at a 20-year low, and students saddled with debt, facing a situation where they can't get jobs, they can't afford homes, lending standards are so tight?
You sound like a cable television lady.
Yeah.
I mean, that's a bunch of crap, okay? It's just a bunch of crap.
Well, there you go.
The bottom line is that there has always been a massive disparity between the rich and the poor in the United States. The disparity has been significantly greater everywhere else in the world, with very few exceptions. I mean, you guys ought to pick up a poster, "I'm for Elizabeth Warren." I mean, you're just, that's just not true. And anybody who makes investment decisions predicated on that doesn't have a pretty good track record. I mean, Tom, let me ask you a question. When you sit there and pontificate over making an investment, do you basically say, I could benefit the bottom half of the people who can't pay me, but I would do good if I did this, right? What am I missing?
I'm not saying he should. I'm just saying, is that what it looks like?
Yeah, I understand what you're saying, but but the point is that whole, misallocation of assets. It's like somebody discovered it last week. This has been the case. In the 20s, the disparity was double what it is today.
Well, but Sam, I disagree with you. I think Stephanie's right. Look, in 2007, the people who really got hit were the people who lost their houses. So we talk about the subprime crisis, and we say, whose fault was that? Was it the borrower's fault? It was the federal government's fault.
How about the regulator who said you can lie on your loans?
I know, but just let me finish. So the federal government went to savings and loans and said, by the way, you have to lend to people who are not qualified to borrow. And this started what we all know was the inevitable end, right? So in the aftermath of this, as the federal government intervenes and as they take over AIG and they take over every investment bank and they bail out all of the bondholders and shareholders of those entities, we all sit and resolve, because you are helping, we all have done that, resolve the people who had no options. And those people today, by the way, have the highest unemployment, are crawling back in consumer consumption, and still can't get a loan. Because of qualified mortgages and losing their house, the credit rating is gone. So house rentals are up. As I said, we're in this business, and you and I talked about it at the beginning, and I'm humbled by it all the time, because what an average family goes through to increase their rent from $1,200 a month to $1,300 a month, you want to cry. 4 people living in a house, mom and dad, they don't want to move because they're in the same public school district, but that recycling of unemployment doesn't happen to a 40 or 50-year-old engineer. So I'm not so certain that it hasn't disproportionately, in American style, benefited amazingly all the financial players who at the end of the day were sitting at the Last Supper at the moment that it all collapsed.
I guess, you know, I'm equally empathetic. But every time we violated the basic rules of economics, we got screwed. Since World War II, every time the home ownership rate got above 64%, we had a crisis. In 2007, it was 69%. That's, I mean, 4% is hundreds of thousands of surplus, non-demand housing. I mean, I went to Stockton, California, and I saw a subdivision of $700,000 homes that were sold to Mexican migrant workers. Now, who are we going to hold up responsible for that? I mean, in the end, we all have to be responsible to ourselves. And our society will not survive if we, in effect, delegate responsibility to the government and the good people. We gotta be responsible, and every single person in our society has to be responsible. 206 and 207 and subprime loans were all about total irresponsibility across the board. There were no saints in that deal.
Should Barney Frank take some blame for the fact that he did make Americans believe it's part of your right as an American, we should own a home? So those who lost their homes, who still have not gotten out from this hole that they're in, should they have not been buying homes to begin with?
Well, look, it's the American dream.
But a dream and a birthright are two different things.
Well, but what else can you get an exercisable, transactable loan? So I said to my 19-year-old son, "You think it's so easy to work? Go to J.P. Morgan and try and get a $10,000 credit card by yourself. You can't, but you can get a $400,000 loan on a condo." So it's the American dream. It's the only thing that Americans have in front of them that's not about a place to live in. It wasn't. It's not about a place to house your children. It wasn't. It's about, I can borrow money and I'll make more money off trading this house or condo than I will of a lifetime's work. That was the hope. And that hope vanished.
All right, we're out of time. Before we go, I just want to give everybody an opportunity. Before we go, what are you most concerned about? I'm not going to ask Sam what he's afraid of because the answer is nothing.
True.
Yes,
true.
Absolutely nothing.
I think that
in terms of real estate, what do you fear?
Well, I think that the possibility of event risk globally is something that I worry about, and I worry about its potential impact on the real estate markets worldwide. Political risk, catastrophic economic occurrence. I think that's one thing. Having been in the real estate business for a long, long time, you know, interest rates, nobody can predict where they're going to go, but I think based on the type of money that I see in the market now that may be much short-term hold focused than long-term, maybe more hedgy fund type trading kind of focus could accelerate the negative impacts of a downturn when it comes.
What do you fear the most, Tom?
Amateurs in the market, assets priced to perfection, global turmoil with no risk premium attached to it. I think it's a great opportunity for real estate. I'm not concerned about what happens in the markets that we're generally talking about, but I think it's a time to be conservative, find credit-like investments lower in the capital stack with equity-like returns, so that when something goes wrong, real estate will recycle and return to itself. Floating debt can choke and kill you quickly.
Eyal, what do you fear?
If you put aside all the political upheavals and all complete regions which are dismantling themselves, and we relate only to real estate markets the way that we know them in the more peaceful and organized countries, then I'm afraid of oversupply.
Again, if you ignore geopolitical tensions, I would say the two things we most worry about would be government interference in inflows and outflows of capital, which distorts the markets for us, And secondly, a bigger issue, which we've not had before to worry about, is currency depreciation, particularly in Asia. It is definitely impacting a lot of decisions.
You fear anything, Sam?
I already said my piece.
Thank you so much to all of you. Thank you this morning. Thank you.